Okay.
The potential
Right,
is there.
it's 10:30.
Okay.
Steve,
I'll start admitting people, and then I'll hand over to you, Henry. Yeah. So let me just
Okay,
start
that's
admitting
cool.
all. So there we go. Here we go. Oh wow, lots of yeah. Good morning, good morning, good morning, good morning, Ian. Good morning, David. Good morning, Con. Good morning, John. Good morning, Peter. Good morning, Eugene. Good morning, Bob. Good morning, Sarah. If you've just joined, if you could go on mute, that would be great, just to cut out some background noise, which would be great. Morning, JQ. Morning, Chris. Just enter a few more people. Good morning, morning, morning. Good morning, David. Good morning, Paul. If you've just joined, if you could go on mute, that would be great. And we can then allow Aaron to do his presentation with Henry. Morning, James. Let's just make sure people are muted. Yeah, which is good. So yeah, okay. It's now 10:32, so we'll kick off. Good morning, everybody. Thank you for joining this week's Coffee Morning with Pension Playpen. We're delighted to have Aaron with us, who's joined us from Washington, DC, where it is 5:32 in the morning. So a big thumbs up for that, Aaron. Thank you very much indeed for getting up early for us. We are now recording, so David, JQ, Chris, Henry, everybody's happy that we're recording. I'll monitor the lobby, and as usual, if you would like to ask Aaron or Henry a question, please raise a hand. And it's very interactive, very informal, as we all know. Please raise a hand and ask a question. I will now pass over to Henry initially, and then Henry will introduce you to Aaron. So let's get cracking.
Okay, thanks very much, Steve. The impetus for this particular meeting was that Aaron and I had started discussing things following a presentation he did with Stefan Lundberg. Some of you may have seen the presentation on pioneering pensions. I was unclear about one or two of the things that Aaron was saying and wrote a blog about it. And Aaron came back and said, you really ought to have a proper discussion with me about this, Henry. And I said, yeah, okay, let's do it on Pension Playpen. So Aaron said, that's great. And then suddenly it was 5:30 in the morning his time. And I thought, this ain't going to happen. But he's a man of strong will and great fervor. And he's managed to get up this time in the morning. We thank him for it. So I'll shut up and hand over to Aaron. And Aaron, perhaps if you can introduce yourself a little better than I have, and then explain a little bit about what SELfies are.
Sounds great. Thank you, Henry. Thank you, Steve. And thank you to all of you for joining. The background for me is I joined the World Bank's Treasury in 1992, initially issuing bonds for the World Bank, because the way the World Bank funds its loans to developing countries is by issuing debt, and typically very creative debt. And in 1995, I moved over to managing the World Bank's pension plan, which was a defined benefit plan. So I've had experience on a number of sides of this fence. But more importantly, the World Bank at that time was going around the world telling people, especially the developing world, that they should privatize their social security systems, which I thought was insane, especially since the staff had a defined benefit. And that led to writing a book with Professor Modigliani, where we argued that privatizing social security was going to be a disaster for a number of the reasons that we've discussed during this call. But most notably that the financial markets were not developed and you were asking people with relatively low financial literacy to make decisions, which most PhDs in finance couldn't. So I left the World Bank in 2002. I went to the dark side. I joined JP Morgan. And for the last 20 odd years, I've been managing pension assets in my own business. But I got back into the pension reform world about 7 years ago, thanks to Kathleen Kennedy, the daughter of Bobby Kennedy, because she was trying to set up pensions in America for people who are what we call uncovered, that is not covered by a pension scheme. And in doing research and writing and advising states in America about that problem, I came up with this idea of a missing instrument without which all DC pension plans are going to be risky. So that's the background and why I'm here at 5:30 in the morning. It's a it's a topic of great passion. I've been doing it for 25 years. And after 25 years, the only one who wakes up at 5:30 in the morning is the dog, right? So that's where I come to this whole discussion.
Okay, so my immediate question is, why do we need a new instrument? Everyone seems to feel that we're popping along quite nicely. We're building money up in this country under our auto enrollment, and nobody seems to be complaining that much. Why? What's the imperative for getting change into the system?
So that's a terrific question. And fundamentally, it goes down to whether or not we have agreement on what the goal of retirement is. That is, even though we were moved from a defined benefit to a defined contribution scheme, the fundamental goal of retirement in very non-financial language is we would like to be able to maintain our pre-retirement lifestyle post-retirement. That's fundamentally it. Because it's hard to change the standard of living, right, just because you have a cutoff date at 65. And so once you have that concept ingrained in your head that this is the goal of retirement, all of a sudden you realize that the promise that you got out of a defined benefit scheme is now highly, highly uncertain, which means that even in countries like Australia, which have done an incredibly good job of accumulation, if you look at their decumulation, which is probably the more complex part of the equation, they've got nothing really to speak of. And we've had a bad experiment in Latin America, which Professor Modiglian and I predicted 25 years ago would happen, is they accumulated a terrific amount of assets. Sadly, the asset managers got paid an enormous amount of fees. But when it came down to the decumulation, all of a sudden people realized that they were getting very low incomes from what they thought they were getting. And so that led to protests, that led to governments, basically having to reform the system. So we've had a failed experiment in mass DC. And that's where you suddenly realize that people actually want some form of guarantee of income so that they can have the quality of life that they expected in retirement. And there is no product today that gives people a low cost, simple, liquid, and not complex, right? When you look at an annuity, which potentially gives you that stream, it's 40 pages of legal jargon that even I don't understand. So that's where we came to the realization that all the focus has been on the accumulation, and especially in Australia, where they call it a superannuation scheme. There's no annuation, right? There's a lot of super, but there's not a lot of annuation.
Yeah.
So the question was, how best do we fix the decumulation side of it? And that's where I think you need new instruments.
Okay, I think we're in agreement that there is a problem converting pots into pensions or in contributions into pensions or whatever it is. There's a problem, and we have it. Right. So we'll come on to South America because I'm really interested in the work you've actually been doing practically there. But before we do that, could you just explain what a SELfie is? See if you can actually do it in such a way that we can all grasp it. And then I'll do a little hand poll to see whether or not we've got it at the end of that.
Perfect. So in doing some research, I read that, let's say, the average UK pensioner would like to get something like £35,000 a year as their pension pot, right? And that is converting their pot into a pension. So if they got £35,000 pounds a year, that would be considered reasonable in today's standard of living. Right?
That's a sort of comfortable end of the retirement living standards of the PLSA, yeah.
That's correct. So let's just take that as the anchor because it makes the numbers easy, but we can always pick any number. So the idea behind SELfies was, why don't we create an instrument which has the profile of a pension, right? And it has the following characteristics. It pays you nothing. So it'll be a government issued bond, which pays you nothing till you get to, let's say, age 65. And age 65 is arbitrary. We can change that number. But at 65, it pays you £10 a year for, let's say, 20 years, which is the average life expectancy of the country. And so why did we pick these values? One is, if we pick £10 a year, now the only math any individual on the street needs to do, whether it's my taxi driver or the gentleman who mows my lawn, all I need to do is, if each bond pays £10 a year and my goal is £35,000 a year, my goal is I've got to buy 3,500 of these bonds before I retire. That's it. No more math. No complicated compounding, no forecasting inflation, nothing, right? Because the bond embeds the accumulation and the decumulation, and it embeds the real adjustment. So the choice of that 10 quid a year was very simply to make the math of retirement trivial so that your average Joe on the street could answer two questions. What's my date of retirement and how much do I want? And those two factors tells you, by the way, you need to buy the SELfies that starts in such and such year, and you need to buy 3,500 of them before you get to retirement, right? And the beauty of this instrument is because it's a government issued instrument, if you change your mind, you can sell it. You need to retire at a different date, you sell it and you buy the one of the different date. If you save too much, you can decumulate, you can sell the bond. If you die early, your children...
Can you hear me? Hang on.
Sorry.
Yeah.
Oh, sorry. So if you die early, your children inherit the bond and they can either collect the coupons or sell it. And so this was meant to be an incredibly simple, low-cost, liquid instrument that had all the benefits of an annuity without locking you up into a complex contract with an insurance company.
Okay. So I said we'll have a poll. Yeah. Put your hand up now if you've got it. Okay, so how many we got? Come on, we can do better than that. +9. Plus, look at that. Right. Put your hands down. This is digital gymnastics now.
Yeah.
Yeah. I haven't even found out how I put my hand down. I've lost it. Right. Thank you very much, everyone. Has anybody not grasped it? Okay. If you still got your hand up, it may be that you haven't got it. So let's come to David Hilton. David, you've still got your hand up. Is that because you're digitally incapable or because you haven't got it?
Digitally incapable, I'm afraid.
Oh, right, not to worry at all. JH, I'm going to try and work out who JH is. John Hampton, have you got your hand up because you're digitally incompetent or because you haven't got it?
Same, sorry, I've pressed it twice.
No worries. Okay. Has anybody prepared to come off mute and say, I don't understand what Aaron's just said?
I think Con's got a question.
Ah, Con Keating. He's a bit of a dimwit when it comes to bonds. Okay, Con.
It sounds as if all you've actually described here is a deferred fixed-term bond. The critical element with a pension is the uncertain longevity.
Yes.
How does the pensioner deal with longevity? I don't see that these bonds help him.
Perfect. Thank you so much, Con. That's the perfect setup to the next part of it. So let me, when we called it SELfies originally, the reason we called it SELfies was it was meant to be a standard of living indexed. So that was the SEL part of it. Forward starting, income only securities, right? So that's exactly what you described, Con, in a much more succinct manner. And that's why we thought we'll come up with a cute little name and call it SELfies. We've now changed our minds and said, let's make it a little bit more serious. So we call it retirement security bonds. But the choice of the average life expectancy was very, very specific too, right? And I didn't talk about that earlier because I was hoping you would tee up this question. So there's three elements to it. And Henry and I have discussed this a little bit. One is for the broad category of people for whom I'm trying to develop this instrument, which is the poor, the uncovered, the low income individuals, the minorities very often, they tend to be the community that has life expectancy less than the average. So more often than not, actually, this bond will cover them through their life, right? So they don't have to potentially buy insurance unless they truly feel that they're going to outlive it. But there's two other elements that come out of this bond. One is our hope is that people potentially consider buying deferred life annuities. So Henry and let's say yourself, who have a potentially longer life expectancy than the average, you could still buy a deferred life annuity, which is going to be incredibly cheap because it'll only start paying at 85, right? So it reduces the cost of it. Two is the insurance companies cannot provide you with a real annuity without the hedging instrument, and that's what this instrument is. So they themselves cannot run an asset liability management profile to make their instruments cheaper without such a hedging instrument. Three is I've actually designed a bond that covers cohort level longevity. It's called the longevity indexed variable expiration bond. LIVE is the acronym. As you can see, I like acronyms. And I'm happy to share that. But what that would do is that would actually cover cohort level longevity, which doesn't exist today. And the last alternative, so we're covering it from many angles, is if this bond existed, a well-run insurance company should be willing to take this SELfie, which pays for 20 years only, and give you a life annuity in exchange for a small fee. Why? Because if they're well diversified and well run, their longevity experience is going to be the average. So if they're able to pool it, and that's when I said CDC cannot be successful without an instrument like this. The only way a CDC pool is going to have any chance of achieving the average life expectancy is if it's well diversified, but then it has an instrument that has this profile as well. So we can hit longevity from multiple angles. We don't need to make this instrument much more complex than it actually is, because otherwise the pricing and the trading becomes extremely hard. Is that acceptable?
Con, you're on mute.
I understand what you're saying, but I think it's fraught with difficulties. For example, if you start to sell this bond to meaningful levels, you're actually going to be altering the economics of the retirement market generally. Those who have longer lives, and I'm not really likely to be one of them, will find that their annuities cost even more than is currently the case.
Not necessarily, because you and I have no clue how long we're going to live, right? It's a complete random variable. I wish we had a better ability to predict it. But even though you may make a flippant comment, and the average longevity of men in my family is extremely low, yet I just, or Indians in general, yet I just had a couple of aunts who turned 90 a few days ago, right? So we don't know what's going to happen. We don't know what's going to happen with the medical technology, right? We don't know when you're going to fall down and drop dead tomorrow as well. And so a well-run insurance company that has people who can do this, they should be able to figure this out. Otherwise, they should go out of business. But without this instrument, they cannot hedge themselves, Con. There's no way an insurance company today can hedge itself against this risk without an instrument that pays them a real coupon that has this kind of profile with long duration. Today, the longest duration gilt is a 50-year gilt, and it has a cash flow that's so skewed that makes it incredibly hard for an insurance company to put into a portfolio unless it's supremely well diversified. This instrument actually allows you to do way better liability hedging than you could have ever done without it.
So
But
you're
more
talking about how you integrate it into the financial system. You're actually saying that this is a product which is integratable into existing plans.
Absolutely.
And doesn't have to be sold as a standalone government bond which people purchase. Is that right?
So what I'm saying is it can be both, right? So what we've recommended to countries is you could have a retail version of it and you could have an institutional version of it. The retail version would be for people like me who don't feel the need to have an intermediary hedge that risk, right? Or poor people who may not even want to bear that cost. But there could be an institutional version where, insurance companies and asset managers will be creative and obviously charge a fee for taking the risk of managing longevity risk. But without this, that's why insurance contracts are so incredibly complex and expensive, right? And why people don't buy annuities. Franco Modigliani made the great comment during his Nobel Prize speech. I think somebody's off mute.
Somebody who is not on mute, go on mute, please.
Thank you, sorry. Franco Modigliani in his Nobel Prize winning speech made the comment about the annuity puzzle, which is given the need and the attractive features of an annuity, why aren't people buying it? It's very simple because it's so complex, it's so illiquid that we haven't given the insurance companies the instruments by which they can hedge themselves. Now, Con, if we have another session, I'll walk you through why my live bond solves that problem completely, right? I do agree. There is a danger that if you're dependent entirely on the insurance industry to provide you with longevity hedging, they are going to expect that only people who are going to live long will want to buy them, right? there is that bias. We know that from economic theory. And that's why my live bond actually solves that problem. But if you want, we can come back to longevity in another session. But for now, let's probably talk about how this is integrated or any other questions that people may have.
We have got a couple of other questions. I see two people with their hands up. Stuart, you had your hand up first. Was that out of incompetence or out of desire to speak?
Incompetence.
Incompetence. Right, okay, we'll move on to Eugene. Eugene, I'm quite sure you put your hand up with a purpose.
Yeah, sorry, I'm in the car, so there may be some background noise. What I want to say, this is to be another guild, a treasury-issued guild, with a different profile. We'll pay 50 or 30 years in the future, some amounts already. So it's nothing new, nothing that annuities can do. It's the same like, I don't know, like a deferred annuity for 20 years. I can't see anything new in this one, and I find it quite dangerous. Think that we have the kamikaze budget and we have these long-dated promises or guilds or what they are, and they will fluctuate by 50% like they did in September, our guilds, by 20 or 30%. So these people will be very, very scared about the retirement, that the government will not be able to pay the liabilities. I find it very dangerous.
Okay, very good question. So let me just take that apart, right? One is, and the argument that we made for Latin America 25 years ago was, at the end of the day, if people retire poor because of a bad financial system and bad financial products, and I'll talk about bad financial products because I'm going to make the argument that every product today in a retirement plan, in a DC plan, is incredibly risky. Okay, so even what you think is a safe asset because it didn't move when the gilt market got shocked is an incredibly risky asset for retirement, because the cash flows that you're likely to receive from holding a T-bill or a gilt, a short-term gilt, is highly volatile, right? Just run the picture, right? Run the analysis. If you held a gilt that preserved your wealth, which is what you've been trained incorrectly by finance theory to believe is the goal of investments, is to protect wealth. Protecting wealth gives you a highly uncertain retirement income. So it destroys the goal that we started with, which is I want to be able to continue my pre-retirement lifestyle. So there is this nice...
This will be even more volatile, Professor. This will be
Hold on. Let me finish. 1 second. I let you speak. Let me finish now. Let me finish. What this instrument does is it guarantees your retirement income, whatever happens in the gilt market. So you've got to change your frame of reference from price action to income guarantee. I am giving you an income guarantee, whatever happens to the stock market, whatever happens to the gilt market, whatever happens to inflation. Your lifestyle doesn't change. Now, the cost of your subsequent purchase could change, but what you've locked in is completely guaranteed. So you've got to now stop sending out these stupid statements that we all get from our DC plans, which says, here's how much wealth you have, and here's the return on your various investments, because it's a completely meaningless statistic. Pick up your retirement statement today and tell me what lifestyle is going to support. You can't give me that answer. If I could tell you that you have so much saved in SELfies, I can guarantee you that that's going to be paid. Now, will a government ever default on its retirees? Even Putin.
Why not? Why not? Why not?
Let me finish. Right? I'm going to finish. Eugene, let me finish. Eugene, let me finish. I'm going to explain it, right? If at the end the government defaults on its retirees, what's going to happen? They're going to have to bail them out anyhow. Even Putin, okay, who's ostensibly a strong man, when retirees protested, he backed down. If at the end you have a large number of UK retirees on the streets because the government defaulted on its bond, they're going to have to bail them out. So they're going to have to pay that bill anyhow. So if anything, they're going to default on the hedge funds sitting in New York and London. They're not going to default on this instrument. There's something called the pecking order of default. And no government will ever default on its retirees. So in a way, this is the most secure instrument you're going to get. Because otherwise, if you trust your insurance company, and I've traded extensively with Credit Suisse, they were one of the best AAA rated, issuers of swaps, and now they're gone. Barclays Bank is run by a very dear friend of mine. And while I think he's a brilliant person, would I trust my retirement to Barclays 40 years into the future? Heck no. So the only
Professor, the UK has already defaulted on retirees. Last
Sorry?
year, they didn't increase the pension as they promised. The UK has already defaulted on retirees. Last year, they didn't increase the pensions like they promised.
Eugene,
So
you're confusing
let's not.
Eugene, you're confusing two separate things. A pension promise can be violated, especially if it's linked to a poor inflation index. A bond which has a coupon structure is governed by certain rules. You have to pay that bond in the manner in which you've agreed, and I've issued bonds to know this. So your whole concept is completely flawed because you're already putting gilts into your pension portfolio. I would bet you that if you open your pension portfolio, you already have gilts, but you've currently got gilts that are very risky from the goal of retirement. So you've already made a bad decision to buy the wrong gilt. Why not fix it and buy the gilt that actually helps you get your retirement income?
I have no guilt myself, and I am fine for retirement.
Yeah, you don't have to buy it. The idea is for the country. It's not for individuals, right? I'm not trying to satisfy every individual. There will be people who won't want this, and that's fine. But for the average person in a country, especially the poor and uncovered workers, this is actually the safest alternative because they don't have to pay high fees to get this guarantee in retirement.
We have this already. We can buy state pension, additional state pension in the UK. And believe me, people, they are not quite keen on this. We have some of this stuff already, so there is nothing that we don't have.
Eugene, can you trade your state pension? Could you sell it?
No, you cannot trade it, but it's good to have it.
Exactly.
And
so
if you want more retirement and safety, you can buy a bit more, and it's good to do it, but people do not do it. This is the problem.
So the beauty of this instrument, Eugene, and I'll send you a couple of papers that we've published, is it allows asset managers to create much better products, which you cannot do by purchasing your state pension. Okay. What it allows an intelligent asset manager to do, and this is what asset managers should be paid fees for, not just naively purchasing assets, is they should be able to guarantee income in retirement by dynamically switching between bonds and stocks. They shouldn't be getting paid fees to just naively underperform the FTSE index or to naively take you from stocks into bonds because that's called a life cycle fund. Do you know what a life cycle fund is? A life cycle fund is a completely arbitrary bet to shift between stocks and bonds just because you became 1 year older. What that does is it makes your retirement income a function of the date on which your parents conceived you. Literally, that's what it boils down to. Is that the gamble you want to take in your retirement as opposed to a more intelligent product that guarantees you income? That's your choice. But I think for the average or for countries on a whole, it's a much better way to manage the risk of pensions.
Eugene,
okay, Jake.
I am so grateful to you for these questions, which really have got to the heart of the matter. But I'd like to, if I can do, move on to John Quinlivan, who's another of our trusted experts on this. And I'd like to hear his point of view. And if you want to come back in at a later stage, Eugene, well and good. John. John? Don't let me down, John.
I'm not letting you down. Can you hear me? Can you hear me?
Yes.
Okay, the reason why people haven't bought annuities in the UK isn't because they were complex, Alan. It's actually because of the annuicide issue, voluntarily killing their capital. And that's what the research has told us. Now, your solution does solve that to some degree. Your point about later life deferred annuities, though, is extremely challenging. Roughly speaking, for every pound of premium for a later life deferred annuity, 50% of that is solvency capital because of the way Solvency II works. And as a consequence, basically the best estimate of what people are paying, they're paying twice as much as they're likely to receive. That makes it economically a really difficult thing to get off the ground.
Right.
Firstly, and secondly, the actual premium compared to a normal annuity is about a fifth of the size. So insurers simply do not have the interest in developing those in the UK without some nudge, shall we say. So your back end long stop protection piece, frankly, is a great theoretical spreadsheet exercise, but it's a pipe dream, I'm afraid.
So John, let me come back to you. One is you don't have it to begin with, right? So you don't have that protection, right? If you can't give me deferred life annuities, you can't give me life annuities to be efficient anyhow, right?
And that's not true.
Well, it's going to be extremely expensive and it's going to be extremely complex because you cannot hedge yourself that far out for a 25-year-old, right? If the instrument existed, you would have a much better chance of hedging yourself. So absent an instrument with long duration, which Eugene finds as highly volatile, and he's absolutely correct, it does have long duration, but without that instrument, the insurance company cannot hedge itself. That's just the basic finance, right? Now, David Blake had an idea for trying to help insurance companies hedge their longevity risk, which I think was a nice starting point, but it doesn't go far enough. And that's why, if you want, we'll do a separate section on my live bond, which is cohort level longevity that can be hedged through a similar instrument. It's a more complex instrument. It's not for the average Joe, but that's the whole point, is let's split retirement into two pieces. One is the income component, and the second part is the longevity component. And when you work out the math, and I've done this for my other paper, if 50% of the population is below the life expectancy of the country, the average, right? Now we've got to worry about the remaining 50. Of that remaining 50, enough of them are wealthy enough that they don't even need a longevity insurance, right? There's no need to buy it. I'm not going to buy it, right? Touch wood, I've been fortunate enough to have sufficient wealth that I don't need to worry about running out of money. So you're talking about a relatively small proportion of people who need to worry about longevity risk. It's that tough group. And for that, the government could create a new instrument which actually would provide longevity risk hedging. And I'll show it to you. I can prove it to you. Will it be economical? I don't know, but it'll be better than all the available alternatives that you have there today.
Do you want to come back on that, John?
People have talked in the past the Treasury about changing issuance and so on, and frankly, they're to little success because they have one.
John, you broke up. Could you just start again, please?
So people have talked to Treasury in the past about different issuance and without any success, because clearly the Treasury have got one objective when they issue instruments, and that's to raise capital. And frankly, they want to do that in as simple form as possible. The challenge that you're putting on the table, even if some of the solutions could work in theory, getting the Treasury on side for something so complex is a hell of an ask. So and your point about hedging. I mean, insurers naturally hedge. They go to the reinsurance market, where basically the reinsurers who are holding life annuities are also holding life policies. So they have a natural hedge.
It's not a natural hedge. Somebody down the road will have to hedge that risk in a more efficient manner, or they're going to charge you capital for that, right? Because they're putting their capital to take that risk. They've got to charge you for it. That's just the nature of finance. And I've done plenty of asset liability management to know that. But the first point that you raised, which is a terrific one, is how do we convince Treasury? And that's why it's taken me 8 years to get this off the ground, right? They've got a simple job currently, which is let's just issue the standard gilts and let people figure it out, right? But now what's happened is they've got a pension problem around the world, okay? And some treasuries are more creative than others. They've got all the principles of this instrument. You've got index-linked instruments. The UK market actually doesn't have what Brazil and the US have, which is what we call a Treasury Direct facility, where I can go and buy directly, but you do have the NSNI system, which comes close, right? It's not perfect, but in America, I can actually buy an instrument off my cell phone, as is the case in Brazil as well. So that's the part where Treasury needs to get with the modern times. Now, one of the nice things in your country is you've got Harriet Richmond, who's an MP, who's the head of the Treasury Finance Committee, who happened to be my boss at JP Morgan. If there's somebody who understands this at a political level, it's Harriet, right? Not a lot of other countries have that level of sophistication within their parliament. So somebody's got to go and tell Treasury, if you keep issuing the standard gilts, you're loading up risk into the pension system. And if it blows up, we're going to have to bail them out. So why not get ahead of the game and actually issue the instrument that people truly need, which is the safe instrument for retirement? And the fault of all of this, John, and I'm writing a paper, actually I've written a number of papers, goes back to finance theory, where the starting assumption is completely flawed. We're taught that individuals maximize the utility of wealth. Wealth for wealth's sake has no meaning. And that's why all the bond issuance has been about preserving principal, right? Eugene is worried about preserving principal. But when I'm saving that money for a goal, I'm interested in retirement income. So Treasury should be issuing instruments that help me preserve retirement income, not preserve wealth. They can issue instruments that preserve wealth for one part of the community, but they should take some of their existing issuance, retire it, and issue these bonds, because otherwise your DC system is just loaded up with excessive risk.
I can see you're talking about the supply side from the Treasury's point of view. I'm really interested in the consumer's point of view. And we have two types of consumers in the UK. We have the pension consumer who's inside the workplace environment, and those people are generally being catered for by auto enrollments. And ultimately, the hope is that we'll find some kind of collective way to accumulate all that saving, or else people will just go their own ways, which is what they do right now, which is very satisfactory. The other type of people are the people outside the system, the self-employed, the carers, all those people who have a certain amount of money in their hands, but they don't have access to a workplace pension and have to make their own decisions. Yeah.
Correct.
And I've been really interested to hear your views on how you can integrate your SELfies into our tax incentivized retirement savings system in such a way that it actually mattered to humans like me, consumers.
Perfect. So let me take the second group first, right? That's the one, that's what we call the uncovered workers. They're outside the system. They're not in Nest. They're not in a workplace pension or whatever it may be. And this is where the example of Brazil is a terrific example, right? So we met Brazil.
Talk to us about Brazil. Yeah.
Right. So I met Brazil in 2019, and unfortunately, COVID killed 2 years. But in January, they issued basically this bond, which pays you, this coupon for 20 years, inflation indexed. And it's offered through what's called the Treasury Direct Facility, which means literally any individual with access to a cell phone can sign up and buy these instruments directly from Treasury. So they don't need a formal nest structure. They don't need a workplace pension, because by buying this bond, in principle, they're buying themselves an individual DB. Okay, it sounds weird, but that's what they're buying. Is they're buying a guaranteed retirement income at zero fee, right? There's no fee. Nest took a lot of money to set up, which is going to be charged back to individuals. These individuals who are at the lower income scale of the economy don't have to pay any fee to get themselves a guaranteed retirement income.
Okay,
right?
Could these be tax incentivized? Could you buy them, for instance, at 75p and get £1 worth of benefit or whatever it was?
So the way they've done it in Brazil is if you hold it to maturity so that you're not trading it, then you get the benefits of taxation, but you also get the benefits of zero custody. So the way they've skewed it to ensure long-term holding is the fees for custody are extremely high if you trade it early in life. Okay. If you hold it for long enough, then you get the benefits. So in fact, in Italy, Italy has a similar system where if you hold the bond to maturity, you get all these bonuses. That's how you would incentivize it in the UK. And I'm not a UK tax expert, but that's how somebody intelligent at Treasury would be able to create that incentive to do that, right? So they don't even need a workplace pension. In fact, I would argue that over time, this concept of a workplace pension may actually dissolve, because most companies don't want to manage a pension system, right? They know how to make cars, and they know how
you're shooting at some sacred cows at the moment, Aaron.
No, but it's true. It is true,
Well,
right? If I'm a manufacturing company, why do I want to run this insurance asset management arm, right? Which I have no sort of knowledge or expertise in. And that's what's happened. That's why DB has gone away. Is the moment the risk was put on their balance sheet, all of them wanted it off their balance sheet. Now you can start to create institutions where people may pool themselves voluntarily to achieve a goal, right? So for the uncovered workers, you don't even need a pension system to do this. For the people who are in Nest, or the people who are in, let's say, the defined contribution plan of a company, now the company can actually create much better target income strategies instead of these silly target date funds or these life cycle funds, which actually allow them to lock in their target level of retirement income. Today's technology allows you to have customized portfolios for every individual. And that's something that Professor Merton has written about, and I think probably also designed with Dimensional Fund Advisor.
I can see companies wanting to offer this as an option to people, but I can see most people still saying, okay, I'd like to be invested in real assets, please. Yeah,
that's fine.
And get real growth and all that stuff. And then you could say, so what you're saying is it's an option, or you can segment your population, or how do you see it integrated into a workplace pension?
One of two things. One is it could be offered as a standalone piece where people say, I've had a terrific run in the stock market, right? These central banks are nuts. They've propped up the stock market, but this is not sustainable. I want to just lock this up. And you buy your SELfies, and now you've locked up your retirement income, which is protected against any fall in the markets, any change in inflation. You're immune to all of that. The others who feel that they need to take more risk to achieve their retirement goals may choose to go into real assets. They may choose to go into equities. They may choose to go into emerging infrastructure. They may choose to go into ESG. But if and when they change their mind and they want to lock that up, they have this instrument to do that. Today, if you have a terrific run, you have no way of locking it up except to just hope that you get to retirement and interest rates are in a sufficiently attractive level to buy the annuity that you want.
Okay, so Arun, we don't have choice in workplace pensions. We have defaults. Yeah. And basically you get in the default and you exercise choice to get out of a default. It's not the other way around. Yeah. We're a very strong culture in this country for that. Yeah. What kind of mechanism could you foresee so that the default for the people like me who are sophisticated and want growth and equities and all that stuff, getting one default, and the people who aren't are defaulted into something else? Is there a way that you can do that without patronizing the people who haven't got, if you like, the financial wherewithal?
Yeah, absolutely. So in fact, in this country, right, in America, the default today is what they call the target date fund, right, or the life cycle fund, which is a completely ridiculous product. To pay any fee for that product is ridiculous because it's a complete arbitrary reallocation between stocks and bonds, right, based purely on your age. And there's no finance theory that can prove to me that that's going to give you any guarantee of retirement income.
Sure. So would you see the default as being your SELfie? I mean, is that the default situation? You'd have to opt out of that. I can see a lot of people getting. I wouldn't
put it 100%. I wouldn't put 100% in this. You could have age-based defaults like you have today, where it rotates from stocks into these SELfies, as opposed to stocks into gilts, right? At least that gives you some level of protection. That's not my ideal product, but that's one default, right? Is at least you can guarantee people some level of retirement income by what they lock up before they get to 65 by having these age-based target income funds, right?
Okay.
I would not design it that way. I would never reallocate strictly based on someone's age, but if that's what the regulation allows, I'll take it as a starting point. But I've written papers on how you can come up with much better strategies based on where people are relative to their target income. The alternative could be, listen, you've got free choice to construct your own. And the third product, which I hope asset managers design, is what we would call a lock-in strategy, right? Which is every time it gets to a new threshold, they lock it in, and then they gamble with the rest of your portfolio. Because to your point, Henry, we're trained in economics to think that, okay, equities and real assets are supposed to give us a higher rate of return than some other instrument. There's no guarantee, right? I teach undergraduates, and the first slide I showed them was in 1999. I did an asset allocation for a $10 billion fund. I asked every professional manager and company, JP Morgan, Goldman Sachs, every one of them, what their forecast for expected returns was for the following 10 years. What do you think that number was?
6%.
It was 9%, right?
Okay.
Back then, this is 1999. This is before we had all the crashes, right? What do you think the actual return on equities was 10 years later?
3%.
Minus 2%, right?
Okay, right.
So we are gambling on this finance theory, which teaches us that we need to forecast expected returns. These assets are supposed to give us an expected return that's higher. It's an expected return. It's not guaranteed. So putting your money into real assets is a gamble, and you should realize that, right? This is the only one that's going to give you something safe in retirement. Now, I'm not advocating that you put 100% in there, because for some people like you, maybe you have that comfort in saying, I think this is going to give me.
So I can see who it's targeted at. I'm going to come back to you. Eugene, you've still got your hand up. Is that because of incompetence or because you got something to say?
Incompetence, but I still have something to say.
Go ahead.
Sure right, go ahead.
Can I go ahead? I think that equities should not be put down by their volatility of price. Young people need to invest in equities and not on bonds with promises 70 years down the line. So they should invest heavily in equities, take the benefit of productivity increases, and all that comes with that. For someone to buy a Brazilian bond that promise something with RPI in the future, that is foolish, I would say, because that bond should pay increases in wages, not RPI increases in 30, 40 years time, because we expect even countries like Brazil to make huge advances in life. So I don't think there could be a treasury bond issued in such a way that could pay a pension. So it's foolish in my opinion. All the discussion that we have.
Okay, so let me take both comments of Eugene. The second one is actually surprisingly a good comment, right? If you look at our
No.
no, I'm serious. I'm dead serious because our original design, right? Our ideal design, to Eugene's comment, is you don't protect people against just inflation. You protect them against standard of living declines, right? So if you read our original design, which we had published in a number of articles, we want people to be protected against changes in standard of living, not just inflation. So Eugene is correct. And in
I
that
wasn't
case,
criticizing Eugene. I was criticizing you for criticizing Eugene.
no,
Surprisingly, Eugene is
no.
a top man. Yeah.
No, I'm just teasing. Come on, this is all in good fun. He's taking down all my arguments and I'm just throwing it back at him. The second argument is actually a superb one, which would be the ideal instrument, and that's why we called it SELfie, was standard of living index. It wasn't inflation index. As a matter of expediency, where countries already had a well-established index market, like the gilts index to inflation, and similarly in Brazil, there's been if you know the history of Brazil, there are a number of indices to which they were indexing, and IPCA now is the acceptable standard. So to get the instrument off the ground, we said, let's start with inflation. The ideal one would be something linked to VAT, your value added tax, because that is the measure of your standard of living. So in an ideal world, that would be what we would argue the UK should issue, but it's not going to happen on day one. So we're being practical about it. The first answer, we're in agreement. I don't know why you disagree with me. I never said you hold 100% bonds if you're 25, but that doesn't mean every 25-year-old has to be in equities. Okay, there could be some 25-year-olds who are extremely risk averse, who are willing to save sufficiently and get the return that this bond offers. In Brazil, it's offering you a 6.8% real return. Would I want to take a chance and invest in real assets and stocks, or even in the UK, right? UK manufacturing is probably going to take a hit post-Brexit. Let's be honest, it's not going to be a stretch. So guess what? Are you going to bet on the productivity of the UK economy for all your retirement? No. So for the people who don't want to take the risk, there should be an alternative, which there isn't today. So Eugene and I are partly in agreement, but I wouldn't say that every 25-year-old should do it. Let the 25-year-olds decide which one wants 100% equity and which one wants 100% SELfies and which one want to be in between. I'm not going to dictate that. That's determined entirely by their goals.
Okay, so how do you convince, we've talked about the Treasury. How do you convince the Treasury that they want to have more of these gilts issued? Yeah. How do you convince the financial services industry, who's making all its money out of managing the assets, to actually introduce these things, which fear, as far as I can see, unless you can take a charge over them and levy some charges on them, are basically not going to make me running an insurance company or me running an asset management company any money. Yeah. Right. How do you get that sorted out? Is this a way of disintermediating the financial services industry?
No. So listen, I'm an asset manager. So, I'll be running myself out of business if I did this, right? I manage money for a living. Yeah. But let's take the Treasury problem first. That's, I think, the most serious one. And that's where people like you in the UK have to go and tell the Treasury that this is what needs to be done. I got very lucky in Brazil that the gentleman I met who was in charge of the private pension system had also issued debt for Brazil. So he understood this idea immediately and he made it happen, right? They've got very skilled technicians in Treasury. So the government provided the cover, but we did have local people who went to the government and said, this makes imminent sense. Actually, the gentleman who helped me, Alexandre Vitorino, worked for Bank Safra, which is potentially one of these that you would believe could be disintermediated, right? So you as UK citizens have got to go and make a proposition to Treasury saying, if you don't provide this, my pension is risky, and that's going to be your burden. Like I said, you've got somebody like Harriet Baldwin, who's actually very, very talented. So you do have people at the right position who, with the right support from the community, could actually make this happen. It's not a stretch, right? They're already issuing gilts. They've got this franchise. It's a simple extension to create a product that actually meets this niche market as well. And it's not niche, it's massive, right? There's trillions of pounds sort of being traded. The second one, which is the harder one, is as an asset manager, how do I convince them that this is good for them? One is they're actually going to be delivering people what they need, which is an income, not a pot, right? Not a highly variable outcome. So they're going to improve the quality of the results that they deliver to people today, right? It's potentially going to keep them immune from lawsuits, at least in this country. When anybody tries to do anything creative to guarantee income, they get sued immediately because the laws are stupid here, right? What's given legal protection is this target date fund, which gives you a completely random pension, as opposed to this instrument. So asset managers that I've talked to here actually like this instrument because they feel it can make better products, allow them to make much better products than they currently have. So the asset managers who get it will want this instrument. The asset managers who don't get it need to be run out of business. I have no problem with that. If you're incompetent, you shouldn't be collecting fees. If you cannot realize that this is the safe asset for retirement and you can make better products, you need to find a different occupation, right? I have no trouble with that.
I'm going to throw it out to the audience. There's a lot of people on this call who haven't said anything yet. Does anyone want to put their hands up and intervene at this stage, or even just unmute and shout?
There's some comments from Peter Cameron Brown and also Chris Evans. So Peter or Chris, do you want to unmute?
Yeah, yes, Peter. I just put a quick chat comment. I wondered why you'd chosen 20 years as the duration and not longer, in which case the issuer's risk is likely to be lower and or shorter when the actual acquisition cost would be lower, presumably.
Actually, that's a terrific question, Peter. And again, I'm just using 20 as a sort of number right now. For each country, it'll actually differ based on the average life expectancy. So we just picked the average life expectancy as the standard number. Now, if you make it longer, then what happens is the instrument becomes more expensive, which makes it a little bit more difficult for the poorer, uncovered people that Henry talked about, right? So we're trying to play this game of how do we make this instrument useful to cover a substantial number of people in the population, yet at the same time not make it prohibitively expensive, because the more coupons that you pay, the higher the price that you'll have to pay upfront, right? And if you feel that the uncovered poor minority populations have an average life expectancy that's less than the economy-wide average, and that's the population you really want to make sure is protected, that's kind of where we've made this trade-off and said 20 years typically seems to be the average. It may be the case that in the UK, if your average longevity is longer, life expectancy is longer, then you may have to make it 21 or 22, but that would be on a country-by-country basis. But that's a terrific question. That's not fixed in stone. That's something that each country has to decide for itself.
Okay, thank you.
Thank you.
Right, do we want to move on? I think, Chris, you had a question, or you had a comment. I haven't seen it, but you want to make it on? Yeah.
Thank you. I did. I'm just really struggling with the concept of the pricing, and maybe it's because, to start with, Aaron put it in a very simple way, but just this idea that, for every £100 or whatever it is, you get a £10 sort of guaranteed income. When you think about a bond, normally you think about it in terms of a coupon and a yield.
Correct.
And so what I'm struggling to understand is, if 1 year on a conventional bond, the yield is, if they're issuing it at 5% or something, and then the next year, because of where interest rates have gone to or inflation expectations are, they'll be issuing one with a yield at 6%. How does that impact the pricing of this bond?
So that's a superb question, Chris. So basically, the way the price is set is it's going to be determined entirely by market factors, right? So just like your bond today is priced entirely on market-based factors, this bond will be priced exactly the same, right? Namely, that the price you'll pay today is nothing more than the present value of the discounted future cash flows, right? So I've got a slightly dated model from, I think, the 24th of February. And if I bought a bond that started paying in 40 years, okay, so I'm a 25-year-old and I buy the 2063 bond, which pays £5 a year in real terms for 20 years, and let's assume inflation is maintained at 3%, the price of that bond today would be £65. Okay, so I've actually got a little calculator on which we base this. So what Brazil did is actually about a month before they issued the bond, they said, here's the pricing formula we're going to use to set that price. And funnily enough, you know, while Henry and I were joking about, not joking, actually serious about wanting to cover people who are, you know, financially illiterate and wouldn't know how to do it, my son works for Citigroup, and when they launched the bond, he got people thanking his dad, and these were traders at Citigroup, right? So if traders felt that the price was okay, and they were buying it for themselves, that was the validation that they priced it correctly. So if interest rates go up, right, to your comment, then the price comes down. If interest rates go down, then the price goes up. Why is this an absolutely important mechanism? Because one of my critiques of central bank policy was central banks were lowering interest rates to boost the stock market, right, for what was called the wealth effect, right? While they boosted your assets, they actually raised your liabilities or your retirement annuity costs by way more. So on a relative basis, we were all made poorer. And if you want, I'll send you that paper, Henry. Basically, it showed that central banks were making a trade-off by hurting retirees or people close to retirement by playing this game of nudging the stock market. With this instrument, the day after your central bank makes a move, you'll see the price of retirement switch instantly, right? So to Eugene's question, actually, again, there he was spot on. You're going to see in an instant the price of your retirement change. This becomes the currency of retirement. Okay. Today, we don't have any accountability for the central banks. They're running inflation at 10%. Guess what? Treasury would be sitting on them saying, you cannot do that because guess what? My debt is now more expensive. So it actually starts to put a lot more focus and control on key parameters than currently exists. Actually, now the central banks and the ministries of finance are under a much heavier spotlight than we had today, because today they've transferred all that risk to individuals, right? And give us no means to manage that risk. So you've asked a superb question. That's why I want it to be a purely market-based instrument so that the market price determines what happens.
But Aaron, then presumably the price, given that the combination of the duration and the fact that it's forward starting, the price is going to be quite volatile.
Absolutely, but the income will not be, right? I don't. Yeah. That's what the reports.
But then to your point about you know, and that's that previous point about buying it and not trading it, because if you're trading it, it's going to be very volatile.
Absolutely, absolutely, and there will be some people who will trade it, right? There will be people who will trade it. I can't stop that, and that's part of the market mechanism, right? That the market mechanism is, if rates are too low, people will sell their bonds because the price has gone up, and then the market rates will come up, right? So the market dynamics will actually create the equilibrium. So you don't want to prevent people from trading it, but to Henry's comment, you incentivize people who are not capable of doing this for a living to actually hold it to retirement. Now, the one other nice comment that your question brought up, which I'd forgotten to mention, is, Henry, what's going to happen in most countries is we're going to have to attach other assets in addition to our pension pot to get a safe retirement, right? Which means your house, right? Other assets. Today, you have no idea what that house can convert into in terms of retirement income. If this instrument exists, you'll know instantly what the value of your house is and what retirement income you could potentially lock in. So by serving as a currency of retirement, it has very useful purposes for overall societal sort of pension planning as well. Okay. Thanks, Chris. Yeah, that was spot on. Thank you for bringing that up.
Great, great question, Chris. Thanks so much indeed for that. Henry, I think Henry's frozen, but there we go. Bob, do you have a question, Bob, at all, or? Oh, you're on mute, Bob. Bob, you're on mute.
haven't got a question other than, Aaron, I get it. I understand what you're talking about. I do believe there's a need for it. The big stumbling block initially is not everybody on this call, and everybody's got lots of questions and queries. It is getting Treasury to issue the retirement saving bonds.
Correct.
And I would make a suggestion that we could well have a government change coming up in 2024. The Labour Party are lacking ideas in terms of retirement saving. It might be interesting to talk with them.
I'll have to leave that up to you, right? Because we've tried to stay as apolitical as possible. For me, I'm willing to work with Republicans, Democrats, Labour, Conservatives, whatever it is, right? For me, the goal of retirement security is not a political one. But it's going to take UK citizens wanting, demanding this of Treasury, right? As an academic, as a quote unquote reformer, Professor Merton and I can do whatever we want. But unless the local market says this needs to be done as part of a pension reform movement, that's the only way it gets done. Right?
Yeah. The other thing I would say is that Mel Stride is now the Secretary of State for DWP. He was formerly Treasury. He would be an ideal person to have a one-to-one conversation with on new ideas. So I agree with you. I'm not political. I'm just saying that where there's change, there are opportunities. And I think the retirement saving bond is something that is hugely useful, and it would be very useful for CDC schemes when they get off the ground.
Absolutely.
And it will be hugely valuable for anybody with a DC pot coming up to retirement wondering, do I really have to buy an annuity? Unfortunately, all the insurance companies will be very anti-retirement savings bond because that will take a large part of their market away, which is what happened with auto-enrollment. Auto-enrollment took a long time to get off the ground because the insurance companies said, well, that'll destroy our GPP market. And they were probably right, but they got into it. So you've got to manage the politics, unfortunately.
Bob, you're completely correct, right? And that is, I think the insurance companies and the asset managers, and I've worked for a number of asset management companies, have had a nice franchise doing, sort of minimal effort, in their product offering today, right? Which is, if the market goes up, too bad, great. If it goes down, too bad. You bear the risk, I take the fees, right? It's always been one-sided. What I'm hoping is that with this instrument, we can change that paradigm to say, if you don't promise these individuals a certain retirement income, you shouldn't get paid fees at all. I jokingly say 2 and 20, which is the standard hedge fund fee structure, should be 2 basis points and 20% of what you produce over the threshold, right? 2 basis points to keep your lights on, and everything else has got to be on the basis of outcomes, not on the basis of the fact that you switched stocks into bonds. So there is a chance to actually reform the industry, which has been very fee extracting. And that's why we were so vehemently against privatizing Social Security, because we told the World Bank, you're going to be taking money from the poor and giving it to the rich, which is the exact opposite of the World Bank mandate. Why? Because poor people joined these pension schemes and the rich asset managers who ran it did just fine, right? So there are going to be people who are going to be disrupted, who are getting very, substantial incomes, but that's probably, necessary. To your comment, if you have somebody who's got both a treasury and a pension experience, there's no better individual. And that's what happened in Brazil. But what's nice is Brazil has had a government change and they've continued to do it. And the success has been phenomenal. I think in the first 2 months, 36,000 people signed up, okay, including 8,500 who had never participated in this market before, right? So they just brought 8,500 people in the first 2 months. I think for Brazil, they raised something like 500 million reais in the first 2 months. Again, a substantial amount. Again, just through this very simple Treasury Direct facility. It's not even available, in a general sort of marketplace as well. So that's where the UK Treasury has a phenomenal market for gilts. They've got the infrastructure. I would suggest that this Treasury Direct is also a feature that's added because today's technology allows you to trade, to buy these things off a cell phone. But I think that I've worked with people at Bank of England when I was at the World Bank, and they're incredibly competent. I'm sure you can get together a very competent group of people at Treasury and Bank of England and show them the value of this instrument, right? That to me, I think the UK is in a much better position than some other countries that are out there as well. Yeah, I've struggled to make it happen in the US, right? I've talked to 3 different administrations. I've talked to an Obama administration official, a Trump administration official, and a Biden administration official. The likelihood of happening in the US, very low, right? Because there's no politician that's got behind it. So I think you're in a much better shape than we are in the US. And so I might have to move to the UK once you issue this instrument.
Aaron, I think you need to come to the UK and bang on the doors of Westminster and talk to Harriet or whoever. Yeah, exactly. So
Happy to do it. Happy to do it because
you should come over. You should come over. It's an interesting stuff. Interesting stuff.
It does, and I think Bob makes a good point. Is we need this industry to be shaken up a little bit, right? The status quo is not going to work. We're all being asked to take risks in our DC pensions, and we're not being given the instruments to manage it. Right? And this is the classic problem in Australia. Australia did a great job of superannuation. I've gone and sold product in Australia. I know what the inefficiencies are, right? There are high costs, there are all sorts of intermediaries, and nobody's focused on decumulation. And people are going to get a shock when they realize how little they get in their pension income. So right now, the euphoria is in seeing your statements say that you've got 500,000 Aussie dollars saved. But when you find out that's maybe 25,000 Aussie dollars a year, you're going to be really disappointed. So I think Australia is now on the cusp of that wave crashing, which Latin America had, 5 years ago.
Yeah.
And I think the UK
I'm sorry to have missed out on the bit of the conversation, but we're coming now to the ends because we've been going more than an hour. And I wanted to say thank you because one, you made this simple. Two, you were effective in everything you said. And thirdly, I think the vast majority of the people on this call have really got something out of this call, which we wouldn't have got had you not got up at 5:30 in the morning.
It's my pleasure entirely. And as I said, Henry, there's lots of elements that can be improved by a group like this. I'm just giving you the basic sort of skeleton.
We're going to take it away. Now, I suggest you get in touch with the IFS, Paul Johnson, and you get onto him because he's putting together a 5-year study on the retirement income problem in the UK. And he has got the ear of the Treasury. So he's your way through to the Treasury right now. The IFS team.
We should make that happen. We should make that happen. Yeah. Definitely.
We're going to have them on the pension playpen before long.
Yeah, we will.
I'm going to allow. I have to wrap up now because otherwise none of us will do any work today. Steve.
Right, Aaron, thank you very much indeed for a fantastic, thought-provoking presentation. Thanks everyone for their questions. Aaron, if you could stay on literally for 1 minute at the end, that'd be great. And next week, we think we're going to have LCP talking on their position regarding DB liability. So we'll give you some definitive ideas on that. If you like Playpen, please register. If you like it that much, please invite your friends. And we very much welcome everybody's support for Pension Playpen so far. And these quality sessions are going down so well. So thank you very much, Steve, for your input and for your taking part. And as we usually say, let's pray for peace in the East. And we've been saying this since February last year, Aaron. Peace in the East. There we go. But enjoy the rest of your day, everybody. Thank you very much, and really appreciate your input and everybody's time. But Aaron, if you could stay on for 1 minute, that'd be great. So
I'll be happy to. Thank you so much.
Thank you. Bye, everybody. Thanks very much.
Thank you. Bye-bye. Appreciate it.
Sorry, my phone's
just hanging on the call to say thanks again, Aaron. I've got to go now, but it's just tremendous and so
tremendous. Yeah, really, really good. Really good.
What I'll do is there were 2 questions that I think I saw on the discussion on the chat later on. I'll send you 2 links to papers that people might want to read, which address this longevity issue and then separately the asset allocation one. Okay, so people might find that interesting.
That's fine. Okay. What we do now, Aaron, is after the session is just to say to you, ask you a couple of questions because we'll post a 1 minute slice of what was that all about. So we'll cut and paste the video, but we'll put it on LinkedIn or whatever it is. But number one, my question to you would be, in very short terms, what is a SELfie? And number 2, what have you got out of today's session? Let's answer that.
So let me first describe what a SELfie is. A SELfie is basically a bond issued by the government that pays you nothing till you get to age 65. And at age 65, it pays you 10 quid real per year for 20 years. And the way we chose those parameters is it replicates the payment you would get from a pension, which is no money until you hit pension age. And then the reason we chose 10 quid a year was if your target is 35,000 quid a year in today's pound sterling, today's standard of living, then the only math you have to do is you have to buy 3,500 of these bonds, right? Why? Because it's 35,000 divided by 10 a year. And so by the age of 65, you want to buy 3,500 of these if that's your target. What I got out of today's discussion is clearly the UK market is ripe for innovation. People are looking for interesting means by which to convert a pot into a pension. And this may be one instrument that has the potential to do that, but it'll take a little bit of lobbying from UK citizens to get Treasury and the Bank of England to approve such an instrument. But there's got to be some disruption to the current industry, otherwise people cannot retire safely.
Absolutely, absolutely. And what is the one thing that you would say would be the good next step for your vehicle, your strategy? What would be the best next step for you?
I think in the UK, it'll probably be, as somebody mentioned, getting in front of the key stakeholders. At this point, somebody at Treasury, somebody at the IFS, I believe it was, who are doing a pension retirement income study, because you want this to be analyzed in the early part of the cycle. And this is not a hard instrument to create. Brazil has shown that this can be done in short order if you have the right motivation and the right people working on it as well.
Excellent. So it's a tried and tested product, basically, and we need to consider it very seriously in the UK. Fantastic.
Absolutely. And custom design for the UK needs. Custom designer for the UK needs.
Absolutely. Brilliant. Okay. Well, Arun, thank you very much indeed for your time today. Really appreciate that. And you know, your good luck with your your quest. So it's great.
Keep trying. You never know when you'll make it. And,
and I'd love to have you back. I'd love to have you back later in the year, because you are, you know, a world authority, not just in the UK, but on pensions and savings, so and investments. So it's great to have quality people like you on the session. So thank you very much indeed, and enjoy the rest of your day. You've got a full day ahead of you.
I'm going to start working now. Thank you so much.
Have a coffee. Okay, take care. Bye. Bye.